Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today I have a buy video for everybody. It's going to be about Medpace Holdings, ticker MEDP. As always, this is not individual investing advice. This is just how I analyze stocks. So I've decided this year to focus a lot on my public videos and articles on the time until payback valuation method. And because it's a little bit unique, not too many people do the same type of analysis, I can use it on most stocks that aren't too cyclical. And it's a little bit simpler way for me to kind of do a valuation that's a little bit different than what other people do that I think is still really effective, and give kind of a taste without getting too deep into the weeds of some of my more precise and in-depth valuation work. So, but the problem is I've just been fulfilling requests mostly lately, and usually nothing is really a buy. So Medpace, I think, is a decent buy right now, and I'm going to show everyone why. And you can kind of see the difference if you compare it to some of the other videos that I've done on stocks that weren't buys or weren't anywhere close to being buy. Kind of what a buy might look like for a growth stock. So let's get into this one here. So Medpace is a $10 billion company, so not like super small, but not big enough to be in the S&P 500. I think it probably is in the S&P 400. I didn't double check that. So I'm going to use, I used GPT to just put a little summary of the business. And it tends to do a better job than when I try to summarize it in just like a couple sentences or so. So they're a contract research organization that provides comprehensive clinical development services to pharmaceutical, biotechnology, and medical device industries, right? And so here are all the things they do: clinical trial management, regulatory consulting, laboratory services, data management, biostatistics, medical device development. And they have a full service model, so they can go end to end with the clinical research stuff. And so that's, what they do and what companies hire them to do, what these biotech, pharma, device makers use them for. So that's what they're into. Not as sexy as crypto or AI and everything, although maybe they'll be using AI, I don't know. But a legitimate business, and you can see from the fast graph here that they have a lot of growth. So it only goes back to 2017. So we don't really have a recession to examine what happens during recession. So that's a risk, and I would treat this as a growth stock. And probably if I bought it right today, it would be like a partial position, okay? Now, in the Full Cyclical Investors Club service, I have a method or a strategy that tries to find these earlier stage growth businesses when they're at a decent price but still growing fast. So we bought this one back in May of 2023, right about, I think it was on the 1st, so maybe about right there. And so it's done really well. It's up about 70%, 66 to 70%. So like a 35% CAGR over the past couple years, even though it's well off its highs, right? At one point it was up over about 450, looks like 440. So it's done really well. And I've also written about this one on Seeking Alpha. It's been a weekly pick. I have for $25 a month, I have a weekly pick over on Patreon now that I started in October. So I featured it there already, and it fits kind of pretty. It's a pretty good business, really, I think, and just a decent one to buy and hold for the long term, or at least to start a position here and hold for the long term. So when we look at the earnings growth, now early on they had like 70% growth. That's probably not going to happen again. So once they kind of got established and got their feet on the ground, let's take it up through this year. So we have 17%, then 27, then 25, then 51, then 22, then 34. So fantastic growth, 29% earnings growth from 2019 through this year. So that's really fast, right? And that's earnings. We aren't even talking like revenues or anything like that. So that all looks pretty good. What we don't know about is cyclicality. We don't know how much of this was helped by stimulus. Certainly some of it was. Although in 2019, they grew earnings 17%. So that was still solid before any of the COVID type stuff came along. And even just last year, they still grew earnings 34%. Now, this year, analysts are expecting only 5% growth. So we're getting kind of a pullback or a slowdown in earnings growth. And maybe even they end up being a little negative this year. It's hard to say after kind of running up, right? We're going to have some kind of a slowdown or normalization, or hopefully it doesn't turn into a bust. I don't think it will, where earnings fall back down to 2021 levels or something like that. That's not what I expect, but it could potentially happen, I suppose, especially if there's a recession kind of at the same time. But sometimes it provides opportunities when the market thinks earnings are going to slow down in the coming year. And if they do slow down, the stock price might fall even more. But so far that hasn't happened. And the stock is, let's see how far it's off its high here. The stock is about 25% off its high. So it's pulled back a little bit. The super enthusiasm of mid last year when it had a 42 PE is gone, and now it's down to like a 28 PE. So it's looking pretty reasonable if they can kind of, over the long term, grow at this rate. Now, I'm not going to assume that they grow at 29%. I'm going to assume they grow earnings at 20%, which is still potentially pretty aggressive. The market is saying kind of mid to low teens probably is what the market's kind of thinking once we get past this year and start going out. So I'll also give a buy price if we assume a 15% earnings growth rate. I think if, the market was trading, if everything else was trading a little bit lower, I'd probably be more inclined to aim for that 15% growth rate and be more conservative. But right now they have shown that they can grow 20% a year, more than 20%. So even if maybe they surprise one more year and they have another 35% year, and then they go down to 20, right? Or 15. So that's how you can end up making a lot of money potentially on a stock like this. And then obviously if they disappoint in earnings, even if they go like 15% negative this year, the stock will probably drop like 40, 50% or something. Let's see what it dropped in 2022. Fell about, like 40%, over 40%. So there's still definitely downside to this. It's a long-term initial position is how I would describe it. So I would consider adding to this one if it fell like 40%. Even if earnings were crummy, I might wait for the things to kind of bottom out and start coming back, but I would definitely still keep it on my radar. I wouldn't sell my position. To me, this is a buy and hold long-term position. Because we don't know what the short term is going to be, but it seems to me like they have a good business in a field that's going to have demand pretty strong going forward, right? So buy and hold potential. Let's get into the valuation. If I can find the right spreadsheet. There we go. So I'm doing a time until payback valuation. This is how long would it take if you bought this business for it to earn the same amount of money that you paid for it. Okay. So if you just theoretically paid $100, that's how I set these spreadsheets up because it makes the math like just simpler and easier. Then how long would it take them to earn $100 for every $100 that you invested? What you need in order to calculate that is the earnings yield, which is the inverted PE ratio. The earnings yield is 3.39% here. And the earnings growth. So in this calculation, I'm going to use 20% earnings growth. That might be on the aggressive side, like I said, but they have shown that they've been able to do 29% the past 5 years. So it's not crazy, and it's worth at least looking at in a market where it's kind of hard to find like a decent growth stock that's not trading at astronomical levels. Even just the S&P 500 is trading high. So when you take this 3.39% earnings yield, that means every $100 that you invest, if earnings didn't grow, you would earn $3.39 on that $100, right? Now, that I'm going to assume that grows at 20%. So the first year, this will be a little bit higher. I'll go show you that. So we go to the earnings yield right there. That's what I just showed you. And then year one, I pull that 20% earnings growth forward. So you would earn $4.07 your first year on your $100. The next year, you would earn $4.88. The next year, you would earn $5.86, and so on. And that money, I assume, would accumulate. I want to see how long it takes to build up to turn $100 into $200 just from their earnings and earnings growth. So the spreadsheet's set up to calculate that, and right now it would take about 10 years to cross that threshold. So 10 years is usually what I want to see, like 10 to 12 for a growth stock. Since I think maybe that 20% is a little bit potentially aggressive for 10 years, that's a long time. I mean, they're only a $10 billion company, so it's possible, but I would probably, if someone pressed me on it, I would lean more toward the 15% for maybe not 10, but maybe 15, maybe they can go longer. So the market, to put in perspective, like the S&P 500, it's going to take about 15 years to earn your money back from the earnings, is my estimate. So the market is about 50% more expensive than Medpace is if they can grow earnings at 20%. Now, if they grow earnings at 15% instead of 20, I have the buy price at $270 a share. Let's see, I can actually just type it in here. So that would be 12-year time until payback. That's still okay. That's like still significantly better. The market's still 25% higher than that. So even if they only grow earnings 15% on average the next 10 years or the next 12 years, you would earn your money back quicker than if it was just in the S&P 500, assuming all the same type of things that I'm assuming here. So to me, that seems like you get a little bit of margin of safety. If things go well, you're going to have a good stock. It doesn't seem to be super risky. I know research dollars are going to probably fluctuate with the market. And maybe interest rates too. If interest rates go higher, then especially the smaller companies might have a harder time, might not have as much money to pay for research and so forth. So, I mean, I think it would definitely be there are situations where they might not do as well. But we don't know exactly what interest rates are going to be, and we don't know exactly what a recession is going to look like. And chances are, over the long term, they'll be able to grow through it. Like, there's nothing super risky with their business that I see over the long term. I mean, when I bought it like a year and a half ago, or over a year and a half, I just bought it for the long term. I really haven't paid any attention to it until I started talking about it recently, like more than a year later, a little bit more publicly, and in in the weekly service, and I wrote an article about it. So it's having these stocks is kind of nice in your portfolio because I really don't pay any attention to it. It's kind of a place my bet, come back 10 years from now, unless something crazy happens. And as long as the returns, I mean, I don't even really base it on returns unless they're really bad. Like if it was down 60, 70%, and I found something to replace it with, then I might look at it and try to decide what the heck's going on. But really, it's kind of just a buy and forget type of investment, and come back in a few years and just check in on it every now and then, see how it's doing. And I really like building a portfolio that has quite a few of these in it, because then you can spend your time looking for new potential investments instead of really monitoring the ones that you have like super closely every earnings report, and everything like that. I've been updating this one like 3 times a year or something, and take a look at it, and then don't pay any attention. I just look, and it's maybe 30% or whatever each year, which is nice. I'm not saying that's what it's going to do in the future, but if you can get a long-term holding that compounds at 15 or 20, in between 15 and 20%, and you don't really have to do anything, I mean, that's the ultimate investment. So Medpace, it's a buy for me. I own it. I plan on continuing owning it. Right now, if a person wanted to take half a position and then see if it does get in one of those big drawdowns or something to get more before they buy more, I think that's totally fine. Because it's not super cheap, but it's very reasonably priced if the earnings growth comes through. Okay, if you enjoyed this, if you found it useful, click the like and subscribe. Like I said, I have a $25 per month Patreon tier where I share one pick each week. Even if there's nothing that's perfect in the market, I find whatever the best thing I can find in the market is. That's been doing really well. I think we've doubled the performance of the S&P 500 so far, and had some really good picks and not too many, like no really horrible ones. We have a few that are down, but overall doing really well. So check that out, and I'll see everybody later. Bye.